start recording here. All right, this is the Tuesday Edge meeting, and we're going to talk Q&A. If you guys are watching this on recording, fast forward it a little bit. We're going to handle some questions, and we're going to get into the certain instances to watch and record and review on your dome. That's going to be the kind of the topic for today. Let me just do a quick sound check. Just Bob, reply. You hear me okay? All right, sounds good. All right, so Rusty's got a great question, and I think that unless you haven't thought of this, you maybe should, and that is, how far away from an entry is the quote sweet spot for the ES of taking a scale out of a 3-lot trade? So the first scale would be one contract on 3, right? 1/3 would be 1. Everybody's emotional sweet spot, Rusty, is different. But for instance, mine is 2 ticks in the ES, sometimes 3 or 4 if it's busier on the first scale. The overall sweet spot, I'd say, is a point, which is 4 ticks, where you're not micromanaging the trade too much if you're afraid of that. If you're taking one scale off at 4 ticks, you're not a scalper, and you're doing yourself a real good, a lot of justice by taking 3 or 4 ticks on the first scale. But emotionally, everybody's sweet spot's a little bit different. If it's going to make you mad to see 2 and 3 tick winners turn into scratches or losers, you got to adjust and be flexible. But if you just were to tell me in the ES, I think a point is a sweet spot because it moves in 4 tick increments or 1 point increments, and you're going to get good at knowing where to say, I ain't taking 2 ticks, I want to take 5 ticks, or I'm not taking 4 ticks, I'm going to take 6 ticks, I'm going to ride this thing up or ride this thing down. So I hope that answers your question. For me, it's 2. For you and anybody else who emotionally it doesn't micromanage as much as I do, 4. If you look for more than 4, you're going to be sitting in trades a while before you get them. But good question. Next question. Bob, he's got 2. I'm going to start charging Bob for questions. I want everybody to ask questions, but Bob, I'm going to start charging you. I did that to somebody else. I started charging him euros because the euro was so strong. Now the euro's gotten weak, so we'll probably charge it back in US dollars. Could you got to elaborate on that question, Bob. Holding the position as it goes against you. Do you have a mic, Bob? I'm gonna enable your mic. Tell me if you could say something. All right. Oh, okay. I remember your question now. So Bob's question was getting stuck in a position. I'd like you to explain this to the group, what you had did. Could you? No, I can't hear you if you're talking. All right. So Bob had sent me an email where he got stuck in a position. And it was about holding a position as it was going against him and going against him. And I didn't want to answer him until we did this meeting, and I wanted to answer him in front of everybody else. When you get stuck in a position and you're holding it and it's going against you, and it's going more against you than you want, it's for one reason. You didn't know where you were going to get out before you got in. So that happened before the trade ever started. You didn't have an exit strategy attached to the entry. So you started allowing your emotions to say, hey, don't get out, Bob. If you get out, you're going to lose money. And you allow those little voices to start making your trading decisions. So if you get a sense, you don't have to have an exact price. You have to have a sense of, if it goes here, I'm out. George is good at that in the trading room where he says, if it goes to here, I'm out. And I'm wrong here. When I start thinking that way, I'm feeling better myself. all right, I'll take a shot. I'm okay with being wrong to here or to there. Then there's no reason then it goes 10 ticks against you, because you should never take a trade that you're going to risk 10 ticks unless you're a real long-term overnight type trader. I think 10, 12 ticks is too much to risk on the kind of day trading that we do. Whether you're micro as much as me or just intraday, you're going to take 12 ticks, boy, you better take, 5-point winners, 4-point winners. Hard to do, especially as the market tightens up. Today we had the best price action than we've had in several sessions. But that answers your first part in the first question. Resting bids and offers. Well, we're going to have a webinar on order types. Not a webinar, but a meeting on order types, and actually put in some orders, and it'll address this question. But I don't use resting bids and offers to get into trades typically, but to get out of trades. You got to remember, when you rest a bid to get into a trade, you got a lot of risk out there. Because if something happens and you're not aware of it, a story or whatever, they zip right through you, you're naked. At least if you're bidding to cover a short, you're out of the position. So, and I'm not saying it's the absolute wrong way to trade, because it isn't. There's just more risk to lay bids and offers to get into trades. So you got to be careful of that. I don't mind laying a bid and offer when it gets close to my price. But for those who say, I like to lay a bid real early in the morning so I'm up in the book, that ain't going to matter. All you're doing is being penny wise in that sense. And you're missing the forest for the trees. Don't do it so you're closer in the book. You don't want to predicate your success on where you're at in the book all the time. You'll be in trouble. Any more questions? Good question, oh Bob, and the order types will be a meeting all onto itself. That's it? All right. You guys can ask questions as we go through, but those that when you watch it, if you don't want to listen to the answers, fast forward it if you're on recording. All right, so let's start off. First of all, this is about order flow instances. We're not going to walk over and through every instance. It'll take too long, and I think that you guys need time to study it and do your own work on it. Because I could recognize it, but I've been watching it for 15 years. This will be new to some people. Some will recognize it because of hearing me talk about it. It's never been, it's not shown in the room. I've never recorded and shown this to room guys. It's only for edge guys. And also, I'm going to probably share the link of a couple of these videos with you guys to watch on your own. Not sharing it with anybody else, just edge members. There'll be unlisted links. Don't share them. They'll only work for you. In a zone, what does that mean? When you're in a zone. And I could promise you, some of you have been in a zone and not realized it. Some of you have never been in a zone. And in a zone, the definition for athletics and other things, this thing is running slow. All right, hold on. Let's just read through this. It's an expression used to describe a state of consciousness where actual skills match the perceived performance requirement perfectly. Being in the zone implies increased focus and attention, which allows for higher levels of performance. Athletes, musicians, and traders, or anyone who totally owns a challenge of the physical and mental performance, can be in the zone. So we qualify. Qualify for being in a zone. It's like that. I was reminded by this when they would talk about how much more floor traders really were absorbing than they knew. The sounds, the visuals, the reaction, my saying the react diligently, right? We're trying to create a reaction, not an overreaction, but a reaction nonetheless instead of thinking so much. Once you think, you're dead. If you have to think too much when someone slams on his brakes in front of you, you're dead. You better know, as a good driver, who's on your right, who's on your left, how far you are away, is it slippery? You check your mirrors, no one's on your right, scoot the hell over. All those things are something that we're able to do. We have the skills and the ability to do it. Most people try to absorb too much or not enough. They're not in the sweet spot. They absorb too much and they just can't, or too little, and you're lost. So the randomness upticks in how you approach these markets. Today, I was able to come back from that last trade, but I felt like I had done a lot better than I did because I was understanding the market. Understanding the market is huge. It's not all of it. If you understand it the right way, it's huge. It's not all of it. You got to execute. Keep going back to execution. Finally, I was able to execute on through to 1 evens. And I also kept my powder dry, as I like to say, by not getting too chopped up ahead of that, being mad I missed a couple opportunities because I was mad. I even said I tricked my mind so much I actually thought I was up good money and I wasn't. That's a good state to be in. But you got to stay in a zone, and when you really know what to watch, you could react. Most people, our competitors, don't know what to watch. You guys, before you came to the edge, didn't know what to watch. I guarantee you, unless you're watching some of this stuff. You weren't watching other markets. You weren't watching order flow. You wouldn't even have a chance. You didn't even know what to look for, right? So in the zone is important because you got to feel like you're in it. So let's go over some of these order flow instances. We're going to go over 2 of them today, not all of them. Big bids and offers that come in the market, all right? Bids turning to offers, offers turning to bids. Second one is a big bid or offer coming in and getting filled and then going the other way. So in the first instance, we'll see it where it follows through one way or the other. The other time, it's like a guy comes in with a big bid, he's got a big knife, and someone shoots him in the head. Sometimes the guy with the big knife wins, and sometimes when he gets shot in the head, going the other way. Those are the best analogies I could give for you or to you. The other ones that we'll go over as we progress in future sessions are resting bids and offers. When they appear, when they evaporate, when they go away, what does that look like? Over and over again. Might be easy to know what that looks like. But you got to see it live because that's when you have to recognize it. And then the other one is a bigger bid or big bid or big offer returning or refreshing. What does that look like? It's one thing to explain this stuff. It's another thing to keep watching it so it's fried in your memory so you see it real time, because remember, that's when you're going to have to watch for it. I hate to break it to you. You got to watch for it in real time. But you got to watch the video in order to know what the heck you're looking for. All right, so how many guys could honestly say that they practice somewhat routinely the quoting exercise? Yes, if you have, put a no if you haven't. All right, so number one, I know these meetings are really good, not from what people tell me only, but from the return audience. Everybody keeps coming back, by the way. And those who can't, tell me, hey, I can't make it, but I'm going to watch the recording. All right. And are there any no's? Scott's not routinely. Tom is a no. Jack is a no. I won't say their last names. Maybe because you haven't had time, and that's fine. It's obviously everybody is on their different schedules. You're not on my schedule. If this whole group worked for me in a prop firm and I had skin in the game for you, you'd be put on notice. Those who answered no. It's the best I could say. All right, so for those, and you could, and you're supposed to stumble. Some of you guys might stumble through it. That's important. You're supposed to. Then you'll be able to kind of mark your progress as you don't. If you stink at it, good. Now get better at it. And you'll know, and don't start, Jack, with the oil. Quote another market. Oil is a market you should do once you get good quoting a slower market. The bonds are pretty good because they move but not fast. Then the ES, then the oil, then do 2. But don't start with crude. All right, so most everyone has done it, and I know the guys who haven't, and they're hardworking guys, so I'm not putting any pressure on them. I wouldn't fire them just yet. Tom, I'd keep you around because I know Tom's a busy guy, and that's really the only reason. But do it. Nothing that's worthwhile doing is usually got a lot of sex appeal attached to it. Do it when you get okay at it. You don't have to be great at it, but when you get okay at it, you'll feel more in touch and in the zone that we're talking about with the market. And you don't have to, and I mentioned this I think last week, you don't have to attach the size to it at first. Just quote price. Quote price, 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 then add size. And you know what? Once you get the foundations down, or I mean like the cadence down, the bid first offer, bid, and then you shorten up and just say the size, 300 by 300 means what? That means 300 on the bid, 300 on the offer. You could say 6/4, 6/2, 6/4, 6/2, 300 up. Once you get that like down, and that's really the hard part, and it's that hard, you guys are watching the markets anyways. So when it's slow, quote them. Gives you something to do without getting bored or without aimlessly trying to find a trade, or that's the best practice you'll be able to do. All right, so let's get back to this. And we've got this Prezi taking forever. If we reconstruct a dome or a price ladder, these are the bids, right? That's the size or quantity on the bid. That's the offer. And that's the quantity that's on the offer. We all know that, right? Remember the difference between a dome and a footprint, though. The dome is what wants to buy or sell. The footprint is what actually bought or sold. It's essentially market orders versus limit orders. If there was no such thing as market orders, the damn price would never move. You got to initiate. There's got to be someone willing to say, just let me buy it. I just want to sell it. Someone's got to lift an offer or hit a bid. So resting offers is what we're going to focus on today. When offers go bid, what's the market doing? Going up. When bids go offer, what's the market technically doing? Going down, albeit one tick, but going down. It has to go down one tick before it goes down 10. Same image that we showed on the previous webinar. 90.75 bid for 599. There's 51 offered at 91 even. Jill, this is your first meeting. When you go back and watch the recording of the quoting exercise, you do some of it. It'll help make a lot more sense of what's going on. So the point I'm trying to make is you're not going to understand the value of seeing what we're going to see unless you know bids going to offer, offers going to bid, what that means. I want to ask everyone, take a look at this image, right? Don't look too deep. There are going to be slight variations of the numbers changing. I want someone, when I pop up this other image, to tell me what the difference is between this image and the next one. The winner, the first one to answer correctly, won't get anything. What's the difference? Josh got it first, the offer. The 90.75 bid is no longer the bid, it's now the offer. The other guys got it, but Josh was the quickest. Now, it's the same image. I just lowered and cut the image down. Same number that is offered, just the price changed. Why is that important? Well, when we watch this in real time and you see this thing flicker, you got to know, what did that bid go offered with? Couple hundred? 600? 900? And what does it mean? Now, the clips that I have on the next slide also have my audio real time in the room, along with some of George's audio. I don't know if you're going to be able to hear it through this Prezi, but I'm going to post it on the web on track 3, some of these links, and when you play them, you'll be able to also hear the audio. You're just going to hear my audio right now. If you can end up hearing the audio through this, we'll just let you guys can hear me talk over this live, over when it was live, okay? Another thing you got to know, just fundamentally before we look at the tape, is what's big size. It's obvious that big size differs from market to market. 700 is not even big size in the oil. It's not going to happen. But sometimes in markets, 700 is real big. Sometimes it's not. Like when this image was taken, you could see how much thicker the order book was. You know why? Because it wasn't volatile when this image was taken. You could see the size in the book is much smaller these days. Another reason why the book was thicker is because the spoofing was going on. People may have had orders in the book they knew that they could pull or some other stuff, but it was more because the volatility was lighter when we were trading 1591. The point I'm trying to make is that you gotta, it's not difficult to do. You just got to know that sometimes 500 is big size and sometimes it's not when it comes in, hits the bid and offers behind it. Nothing on these images, guys, shows you how much traded. It just shows you how much wants to trade. The footprint shows you how much traded. This shows you how much wants to trade. Remember what I say about if you want to know how somebody else feels, try to think about how you feel in the same situation. How do you feel when you have to absolutely buy something? You go to buy it, you could have got it, and now it's gone. I don't care if it's in a trade or a house or a car, and you were like, you thought too long and you wanted this car for $45,000. It was a used car and it was a car you wanted, unique, and you go and say, okay, I'll do it, and the salesman says, I just sold it. How do you feel? You feel like chasing. If he would have come back and said, hey, this guy just, his credit wasn't good enough, so I got this car again, but it's my boss wants to sell it for $46,000. You're going to say, I'll take it, because you know what it felt like to miss it at 45. Now you really want it. And if you didn't want it at 45 and you went for it and didn't get it, now you really want it, right? You want what you can't have in life and in trading, especially when it means there's money. If you're short and you buy it to get out and you miss it, you're PO'd and you're anxious, you're emotional, everything else. If you go to buy something to get long and you miss it, you're mad. But if you go buy something to cover a short and you miss it, you're even more mad. Just goes back to the old saying, you want what you can't have. So when a big order comes in and a lot is behind it, you could assume a lot of people are trying for the same thing. Follow through is likely. So if a big offer comes in, look at my cursor. Let me write on this thing. So if look at this picture in here. The best bid is 90.75, best offer is 91 even, right? It changes on this image. Now all of a sudden they hit the 90.75s enough to take it offered for 751. Let's assume that 751 is big size. And you're like, oh man, a lot of people wanted to sell it. 2 seconds ago they could have done it. Now they can't. Think they're mad? Think they're anxious? Of course. So it could mean that they hit the 90.50s and they hit the 90 quarters. And what does that mean? That's the market moving lower when bids keep getting hit and turning to offers. So another thing that I want you to watch that you're not on this image, and it'll give you a sense of what big size and small size means, and that is, what's the balance right now? This isn't going to make you a great trader, but it's going to help you understand the whole process. The balance right now between, let's just focus on this best bid offer right here. The balance is pretty equal, right? There's $5.99 on the bid and there's 751 on the offer. That's pretty balanced, correct? Now let's say there was only 51 on the offer and you wanted to sell it. Should you hit the bid to get short, or maybe work the offer with a resting offer? Work the offer, right? Just logically, you got a much better chance of this market trading 91 all the way through than trading 90.75. Just think of pure logic. So you'd be crazy to hit the 90.75s at this point. Not only is there only 51 offered at 91 even, but it's trading. Meaning people are buying and selling it there. That's why it's yellow. For Market Delta Trader, when it's yellow, that's the last traded price. That's the last buyer and seller shaking hands. So when this is going 51 to nothing and flashes 91 even bid and they're small, you put an offer in there and you'll probably get filled instead of going and attacking the bid to sell it. So just understand that balance. I think Woj mentioned it a little bit yesterday when working in order to leg in and out of spreads. But even when you're just getting in and out of outrights, when is it time to hit the bid to get short or rest an offer? This is one kind of criteria to watch. Let me stop and answer a couple questions that just popped in. Jeremy says, when the yellow price level changes, but the bids offers do not, what's happening? Well, they are changing. You probably just don't see the bids and offers changing. They're getting refreshed. They are changing. It's not going to go yellow without at least one contract trading. So the criteria for a price going yellow, a criteria for, in this image, for this price to now be yellow, something has to trade on the bid at least one time. So if you see one contract trade, all intents and purposes, this number should look like 598 if one contract traded on the bid. But people are constantly putting in and taking out bids. To understand it at a very beginner level, just think of it as there's 599 people, and once they all been satisfied, the market could go down. So if technically speaking, if one guy says, you know what, I'm going to sell 599 contracts on the bid, he should get filled, right? Because there's just that many. Now let's say the guy, and just think this through, let's say the guy wanted to sell 600 contracts. What would happen with everything being equal is all 599 would get filled and there would be one contract offered at 90.75. So then it would look like this in here. But this would be one contract because he's got one left. He only got filled on 599. Now that's not going to happen that perfectly because there's all kinds of different other people wanting to buy and sell when prices change. So when you see it go yellow, yellow back and forth, there is at least one contract trading and then the orders are being refreshed. Just because a bid trades doesn't mean it's going to go offered. Let me read the back end of your question. For example, 91 even bounces to 90.75 and back, but bid offer levels do not change. Yeah, well, that's kind of I should have read your whole question through. But that's all that's happening. You can go back and forth all day long as long as there's size there. In the footprint, you would see the quantity that's trading. They'll flash the quantity, a lot of domes, next to the number. But that's going to change as the quantities that trade changes. So let's say 3 1 lots trade in here. It'll go 1, 2, 3. Then 10 more trade, 13. Then if the offer trades and comes back, it'll reset to 0. Meaning, and let me walk through this because it's important if you don't know it. Most domes, right now, the last traded price is 91 even. Okay, it's yellow. If someone sold one contract, then this price would go yellow. If they sold another one, there'd be a 1 over here. If they sold another one, there'd be a 2. Another one, there'd be a 3. 3 more, there'd be a 6. But then someone trades the offer one time. That would be 1. Then they trade the bid. That would go back to 1. Then they trade the offer, would show 1. Then they trade the offer again, it would show 2. Would accumulate. The footprint would also show the accumulation, right, on the right side of the X. Time in sales would show an accumulation. But as soon as it trades the other price, it resets it to 0. That's where the footprint is good because it's showing you more accumulation at that price when it's bid or when it's offered. It's really important to go one of the videos I did in track 3 of, how the footprint is, what's it keeping track of? It's keeping track of what's trading on a price when it's bid and what's trading on a price when it's offered. Right side, left side of the X. Lee asks this next question. Did I cover that? So Zane says, what about the gap in there? I have seen that happen. I guess no size in a thin market. Yeah. I mean, here's the thing. When there's a gap, that's because in that instance, all the people who are offering say, the hell with this. They pull it, and everybody who wants to buy it got to reach. They got no one to buy it from. So you'll see 3, and that happens when there's an event or a big number comes out and misses. You'll see 0 by 0. That's because SOB's on the offer saying, I ain't selling this thing. Hell, I want to buy it. So there's no one to buy from, no one to sell to. And so you'll go up or down quicker. And those gaps up and gaps down typically are around big events, big numbers, big misses, and things like that. I got to get some water. Give me 1 second. Let me just add to the quoting stuff and the people that haven't done the exercise. Don't feel guilty because most of you guys didn't do it because you're busy and you got other things going on, and you will do it. It's not from a lack of work ethic. Nobody in here. There's a low probability that if you're in this room today or you ever listen to it in the future, you've invested in this course. A low probability that you're lazy. And so the guys who haven't done it isn't because they don't think it's worth it or they're lazy. They're just busy in other things that they've done. But it will create turning a weakness to a strength. Let me add this because we're going to talk about this later in another meeting, but it's about weaknesses. And how many people in here have owned a business in the past or now, have employees, or in the past have had employees? How many people? Brad and Chris, I'll get to your questions in a moment. They're good ones. All right, so a good amount of you. That's the other thing, is a lot of you guys have been successful in other businesses, still are. That's not why you're trying to trade. It's why you took a course like this. Like I said, there's a uniqueness to people that come to this course, and that's why it's like its own filter. And what I said about, if you haven't done the quoting exercise, don't get guilty about it. If you haven't done it in a month or two from now, then you got to weigh how important this is to you. The reason why I bring up, and most of you answered you've had employees either now or in the past. If you were good at managing people and managing employees, you always knew the strength and weakness of your workers, right? And you tried to play to their strengths and play away from their weaknesses. Now, if their weaknesses were so big, you fire them. But everyone, as humans, have a weakness. It's just part of our nature. And it's like, here's an example. IT. IT guys typically aren't very good at communication, right? And yet they're supposed to be in a support role. Dave is one of the more unique IT guys where he's great communicating, and I get a normal conversation with a lot of IT guys. You guys know what I mean. You can't, that's not their strong suit. So should you have heavy phone support if you had a crew of IT guys that weren't good on the phone. Even though they were great at helping and solving the problem, if they say things that are out of context because they're not good, that's their weakness. So you play away from their weakness, and you don't have phone support. You find another way. These people are great at fixing problems, getting to the problem and the solution, but they're not good on the journey. You play away from their weaknesses. So you do that in business, and that's about running a good workforce. It's about, getting the most out of your employees. It's pretty logical. In trading, you're the boss, you're the employee, you're the customer, you're everything. And that's a big difference between what you're used to when you had employees and now, because you can't afford to play away from your weaknesses. You can't. You can get away with it with employees. So you have to make your weaknesses not your strengths, but you gotta work on your weaknesses. You don't when you had an employee. Like I said, there's other solutions. You could just not have phone support. You had someone who was a strength, who had a strength in that area, and he was able to play towards that, and this guy away. It's more strategy. You could do that in team, like in team sports, right? Think about a team sport where in basketball, you got a lead to protect. You put in your guys that are a little bit better at defense and rebounding. You don't need your scorers in there, especially if you got guys that are better on defense and rebounding, right? So you play to those strengths and away from their weaknesses, because that's what the game calls for. It's not that easy in trading. You have to make your weaknesses your strength. And one of the ways of following a market is doing an order flow exercise, or doing and seeing some of these other exercises, or being part of a team. Listening to this trader I traded with over the weekend, it really reinforced. I felt great to hear a guy who isn't just a trader. He's a guy who puts on 200-300 S&Ps like they're nothing. And I know this for a fact from him. He didn't say that. I know it. He didn't have to say it, and he doesn't say it. He's a humble guy. If you ran to him on the street, you wouldn't think that he could trade one lots or spell one lot. And he flips around 200 like they're candy. And is a well-spoken, smart guy, but not on an intellectual level, just on a work ethic wise, and has weaknesses that he makes them his strengths, or makes them less of a weakness. Don't play away from them, but make them less of a weakness and cuts his size, because he knows, this was what he had said, he knows that's a weakness, and how do I play and make it a little bit more of a strength? Cut my size so I could focus a little bit better. That's just one kind of micro example. Point is that you got to make you can't ignore your weakness like you can in other businesses. You got to make them strengths. In a team environment, the room to a smaller degree, but these meetings and this interaction, and I'm only going to advocate so long for you guys to create smaller groups. But let's keep going, and I'll suggest who should talk to who on a daily basis as we get rolling. We've got a good amount of people in here, and I think that smaller groups are important. I'm not going to organize them, though. I'm just going to suggest who should pair off and communicate. That's how you make your weaknesses better. That's how you create a team sport out of this. That's what this is allowing everybody to do. So I just wanted to jump to that, because we'll do a whole meeting on weaknesses, and I did some variation of it for room only guys. I didn't ever do a public one. I'll do one that's a little bit more in detail, and maybe even bring on this guy that I heard. I don't know him really well, but I'm going to reach out to him. He knows me, and I know him. If I seen him on the street, it would be one of those instances where, are you? Yeah. Are you? Yeah. And really good kid, though. And he would be great for all of us to hear and even communicate. And one of the things he wanted to do? One of his goals, he's been trading for 12 years, his network is to become around other traders. Even though he's still from the same firm, he says there's some great traders and everything, but he wanted fresh input, and input on different levels of experience, not just, you know, the one 12-year experience and input he got from guys coming from that background. All right, so let's go to the video. This is where it's going to get a little flickery. You know what? Let me answer Chris and Brad's question. If there is a lot more resting volume on the bid rather than the offer, is price likely to go down? Yes, especially if it's a lot less, but likely to, not always. He says maybe one of those odd English questions, but it's something I've heard. Yes, but you can't count on it to make your strategy. Just one of those things you could layer and dot one of the I's. And I think that it's not an odd English question, in my opinion. All English questions are odd from you guys over there. Just kidding. Ken is here, so I could say those things. If any English guys get mad at me, Ken's here to defend. Ken still thinks the Revolutionary War is still going on. He sits in his red jacket and bayonet while he trades. But good question nonetheless. Brad says, if a seller hits the bid and takes out all the bids, but the seller still has more to sell, does that mean that the seller will probably hit the next lower bid and chase it? Yes, yes, yes. I actually have an instance of that I'm not going to show today. Maybe I'll show it today. I don't want to show all these videos and overwhelm people, because you got to take these videos and watch them, and then record yourself. This is someone else doing it, and she's doing it, and she's getting the most out of this. Not just recording it, but clipping them and sending them to me. It's a big favor, and I thanked her for it, and I thank her for it. But it's something that, in order to really know that you guys, it might chew up some resources on your PC, I'm not sure. But it's worth it, because it allows you to have this library. And I'm building it, we're building it for you. So let's just get into it. We're going to cover big bids and offers coming in, like when they drastically hit the bid. All right, these are the 4 videos. You guys should see them. Let's say that, let me give you a walkthrough of this first. Let's say this is the bid price, okay? And this is the sell price. They're on an angle, right? Just like on the dome. When the sellers hit the bid and they take them out, and that's the phrase you use. They took out the bid. And now the bid becomes the new offer. And now the best bid is down a little bit. What quantity does he come and hit the bid with and offer behind it? Kind of in line with what Brad just asked. If he hit the bid, let's say there was just 400 there, and he took them all out, that means 400 had to trade in order for the opportunity for the bid to go offer. And then the SOB wants to sell 700, which let's assume is a big number. If there was volume and there was a pit, here's what this would sound like. Lower your volume if you don't want to get scared. If the market is one bid at 2, one bid 400, few hundred at 2, 1, 2, 1, 2, 1, 2, 1, 2, it's one bid, right? And all of a sudden someone comes in and says, sold 700 at 1. That's what they would yell, 700 at 1. And all of a sudden the noise would get a little louder. Because not only did he sell it, he's got a lot. If 700 is a lot in this example, the tempo would go up. Voice would go up. Might scream. So you'll hear my voice go up when you play these links. don't think you're going to be able to hear my voiceover when it was in real time, but you will when you replay these. So imagine you hear that when you see this. One of these are too blurry, but I pull it over on a YouTube, so we'll be able to watch it there. Let's watch this one first. 86 even is where buyers were defending, and I'm going to show you how I know that. And then a big offer appears that pushed it through it. This is where it might flicker a little bit. So hold on. Give it a chance to load. Hey, just Bob. Are you able to hear me still, Bob? If this doesn't play through Prezi, I'll just go on my YouTube and show it through there. So it won't be that difficult. Always got a backup. Now see, this is not loading. Glad you like it, Tom. What's acting up is Prezi, so I anticipated this was going to happen. So let's go to Plan B, and I've got this on my YouTube channel. Hang tight, guys. All right, there we go. All right, you guys should be able to see this. I had to go to HD quality, so when you guys replay this link, make sure you go and select HD on here. Now, do you guys hear me talking in the background? I paused it a second. I don't think you guys hear the voiceover, or do you? I'm going to play it. Let me know if you could hear it. I actually prefer you not to be able to hear it. All right, you guys didn't hear anything? Good. All right, that's good. So I'm going to do the voiceover. When you guys replay this, because I'm going to share these on track 3, you'll hear my voice. You have the pleasure of listening to George and I's voices. All right, so what's going on here is this is the charts you guys see in the room, right? And Julia is doing this for us. She's a longtime Edge member, and she's got my charts here on the 4PNF. This is a 4PNF. This is the 6, right? And in this particular session, this is the third time down. See this once, see this two, see this three time. And this is like the fourth time on a 4PNF. This would be 1, that's 2, this is 3. This is starting to walk down to be 4. I'm looking to get short. And I've cut my size because it's taken a while from what I could hear myself talking. And I just want to go into, I think I sold 90.75s, but I just want to walk in, show you what I seen, and then you guys could take it from there. So I'm going to play it through, then I'm going to rewind it. If some of you guys are real old, so focus in on the right side. Don't look at the charts. All right, it's 91 even bid at 91 quarter, right? Here's the other thing, is the screen share. I just paused it again. The screen share is like a 2-second delay from what you hear my voice typically. So when you guys get this link and are able to play it back, it'll be jive a little bit more. All right, here we go. So right now it's 90.75 bid, 91 even offer. Wait, one more thing. I can make fun of the older people because I know Jim, and he's pretty old, so he lets me do that. All right, here we go. All right. So what we're saying in the background is, if you're long, how could you be comfortable, right? All these taps onto the bottom of consolidation. Do you see the best bid and offer are generally just a couple hundred up, 300, all right? So keep watching. Small bid, 90.75. Keep watching the right side, 300 goes 90.75 offer and goes bid. 300 up. Now I just said in there, now it's got a chance to go. And let's just watch what happens. I offered them there, got short. Boom. This was the better one. One comes in, he offers, I'm going to show it again, don't worry. This one he comes in, hits 90.75, and you see him offer 574 behind it. Let's show it again. Oh, someone's play. There. Now my voice goes up, and you'll be able to hear this on the replay when you guys are able to watch this. That was the instance where he hit the 90.75 and offered 500. Hitting 90 half was even a better trade. You'll hear me sell 90.75s, and it flickered for another 2 seconds. The better trade was right there when you seen him hit 90.75 bid and go 550 offer. Watch, I'm playing it again. 90.50s go offer, and I'm saying on the recording they should go lower. Offer, offer. I'll pause it again. Let's see this again. I want you guys to be able to watch this and take the slider at the bottom back and forth. Wait, I didn't go back far enough. All right, right in here. Watch this See my cursor? Watch this 232, which is the bid. Watch it when it goes from bid to offer, how much fills into the red. Right there. See that? If you didn't see that, I'm not going to replay it. You can't watch this every uptick and downtick just when you're ready to do something. You get good at recognition of that. All right, Tomas asked one more time. I'll do it for you, Tomas, because I like you. I got other ones I want to show. This isn't just the only recording. Keep an eye on it. Keep an eye on it. Right now. See it? Now I'm going to play it. I just pause it. Watch how quick the market goes down. 50s go off or 90 quarters get hit. They go off or 90 evens get hit. They go off or 89.75s traded out. They go off or now this is a momentum trade. This is what you want on a momentum trade. You're not necessarily going to get 2, 3, 5 points, but that's what you want. You get the market to go down your way. And maybe you get the market to give you a head start on a longer term trade you want to do. You get a 2-point head start, you're in good shape. All right. I just paused the screen share. Let me go over and pull up this other video. Man, everything is running slow here. I'll answer you guys' questions. Let's watch another video. Then I'll go through some questions, and then we'll go. Don't worry about in a day or so, and I'll email everyone. I'll post these links on Triad 3 because I want you guys to watch them. Oh, this is a good one. This is a real good one right here. Of course, the exact thing happened, Bob. This is not going to work every time, but they're high probabilities. This is what you're looking for. This is order flow that nobody else teaches it like this. I don't think in the whole world. Maybe somewhere on Mars or Venus they're teaching it this way, but not on this planet. All right, what's taking this so long? Shoot. All right, it's a little blurry, but don't worry about it because you don't have to see it clean, and it'll be clear when you guys replay it on your links. But a couple things in here. Let me go over what the chart looks like. I'm going to pause this right there. Now, I said the title of this video, and I'll answer you guys' questions about this. Let me show another video. The 86, this is one way to use volume imbalance. The 86 evens. This is 86 even, by the way, right here. Do you see how the green imbalance, it kicks up there, he comes in here. The buyers seem to be defending this area right in there. You can see how they try to go up. They can't. So longs are a little nervous, as you could read the context. Then you got all these greens in here. And to me, if it leaks below 86 even, the downside's the right side. And that's where the bulls say uncle, the longs say uncle. All right? So you know that context before this happens. Now let's look at the DOM to see what happens to trigger an execution on a short because you're bearish from what I just went over, or because you're bearish for another reason. I got to rewind it because it already happened. Remember, the price that the bear's been defending is 86 even. I'm going to zoom in. That's this price right in here. Market's a few ticks above it, right? Okay, let's play it. Oops. All right. Watch what happens at 86, right in here. Right where my cursor is. Comes down pretty sharp. You know what? It skipped over when she did this. But 900 came in, and you see it right in here. See 86 even? Came in kind of hot. He offered 900 at 86 even. You'll hear on my voiceover when I was doing it, I hit 85.75 and I think missed it because I hesitated. When she recorded this, it skipped over seeing it come in. But you see how he's in there right now? The next few ticks are easy, and they walk it down, I think, to the lows. But you're seeing 86 even go from bid to offer. Let's watch it again. And you see it skip down. This one isn't as good because the recording skipped through 86. Just watch 86 even. I'm laughing because you'll hear why I'm laughing when you hear my voiceover. I went to sell them and I seen the 900 come in and I hesitated. That's what I'm saying on the voiceover. And I can hear myself getting mad because that was a good trade. Let's go to another one here. Pause that. Let's go to, well, this one's kind of blurry. Let me pause it and go to the I'll stop the screen share a second and pull up the YouTube. While that's pulling up, let me answer a couple questions. So Dave asks, so you are hitting the bid after you see the downtick with the big offer? Yes, so you want to hit the the bid typically below the one that's heavily offered if you anxiously want to get in. Absolutely, because you'll probably miss it. You could try to work it there, but you probably just want to click the next bid lower. Good question. Brad, ideally it would be good to be able to watch the orders on both sides, but which side should I focus on to help me slow this down? The bid side or the offer side? I can't, you got to watch them both, Brad. You have to. But if you're looking to get short, you want to watch how the bids turn offer and with what size. Bob, another $5 for this question. The exact same thing. Oh, it was a comment, so you save yourself $5. Tom generally asks good questions. So if a trade occurs that reduces the offer and the bid by 50 with the quantities that are resting, that will not tell you direction, right? Only the footprint will tell you whether that was a buy or a sell. The footprint will tell you if that was an aggressive buy or sell. Yes. If it just goes down by 50, that means could have been 51 lots that sold into the bid, let's say. You could assume as the bid is shrinking, the size of the bid time is shrinking, that people are aggressively hitting it. Does that make sense? And the footprint would start accumulating. That the footprint, the number on the left side of the X would start going up, and the size of the bid would start going down. That part, that explanation should make sense, right? Yeah. Aggressive. You guys got to look at it as, like I said, one bid and someone says, sold 500 at 2. He yells, 500 at 2. Or sold, really, if it's 1-2 and he sells it, he says sold 500 at 1. That means he just sold all the ones and he wants to sell 500 more. That's even more aggressive. See, in the pit, when you yell sold to someone, that means you hit their bid for everything they got. So if a guy says, and I'm going to show you this in the next video, one bid 500, someone says sold, that means he wants to sell all 500 of them. That's like a guy bringing a knife to a fight, which sometimes could win you the fight unless you get your head blown off. That's the next video I'm going to show. Remember, you guys are going to have access to these links with the titles of them, and you'll have my voiceover on them. You got to watch them. There's a lot of good videos I have. One to show, we're going to talk more about the head fake at a future webinar, and I'll show you good execution for that. All right, here we go. This is a good one. You guys don't have the screen share yet. Let me just run this to HD. You guys know how to go to HD, right? When you're on YouTube, bottom right, that little gear. Run it to 720, which is a HD. It takes a couple seconds. All right, this is the best it's going to get on this screen share. Let me show. Okay, so you able to see this now? Okay, yeah, you are. All right, so just watch it. What did you see? What price went offered, and with how many? Let me rewind it if you're thinking about answering. Watch this. What price went offering and about how many? 73, and it went offer with about 500. 73 is the answer. It's blurry. It's probably hard to see, but you guys will be able to see this clearer when you guys watch it. Now, I got to show you something that's more advanced and part of building these scenarios out. Okay? I'm looking at the chart. I was bearish. I'm looking to get short. I'm listening to my voiceover. I see a guy come in right here. Oh, shoot. I know this is blurry, but just stay on it. Seems like it's getting more blurry. Well, that's why. It won't let me go up to HD. All right. It was right here. I want to show you this. Right there. Yeah. I got a lot of things running on here. All right, hold on a second. Oh, there it is too. This is good. All right. Right there. And just bear with me. You guys are watching this, right? Right here, I'm going to try to draw it on. This is 73.25 the price, all right? It goes bid for 511. Now, I'm looking to sell this thing, and I don't remember the reason, but I'm bearish. I see that come in. I don't buy it because I'm not looking to buy it. This is the example of someone coming in to a fight, and they got a big, long knife. And sometimes a big, long knife is dangerous, and the market will go up. Sometimes someone pulls out a gun and shoots the guy with the knife in the head. And that's what happened. 73.25 go bid with big size, and they give it to them. And then they end up offering 73 evens with bigger size, and the market shoots right back down. Or goes down. In the pit, that would sound like this. Someone says, 2-bid 500. Someone says, sold. Think about that. Some guy says 2-bid 500 and it's a big order. They go, sold. A quick silence would come over the pit, and then a roar would happen. Quick silence to say, did that really just happen? That's this big order coming in for 511. Let me play it. Watch them take it out. They're going 73 half bid. Boom, they take it out, but they only offer 200 behind it. Let's keep watching. They're just hanging there, hanging there, hanging there, hanging there, hanging there, and then wham, he hits it. 73 even, offers how much? 660. This is really blurry. It'll clear up when you guys watch it. I'm going to post these links. I'm not going to email. I'm probably not going to email. I'm going to post them on Track 3 so you guys can have them, and you'll click the link and be able to watch it. But I've got all these things on this PC, and I can't go up to HD. But watch that instance, and you'll have my voiceover to hear on what to watch, so you don't have to figure it out for yourself. It'd be real helpful. And this is why I never did this. I've never done this for even just trading room guys. Never have I walked over and through this, because it's too valuable, number one. I don't think they deserve it. And I don't need to answer a bunch of questions that are attached with this kind of information for people who aren't as serious about this business as you guys are. I'm going to pause the screen. Let me answer a couple questions. So if you want to if you want to sell it, Zane, you would use this instance to get short and hit the 72 3/4. And listen to these recordings to what I do. All right, Tom's got another question. Continuation. So you could then say that an aggressive buy or sell moves price. I'm going to say it should move price, yes. Without aggressive buys or sells, Tom, price would never move, right? So a bid going offer, offer going bid. Then while at that price, resting bids and offers will execute, adding volume. But because they are not aggressive, not moving price unless the quantity is exhausted. Exactly. But think about this. A big aggressive buying that lifts the offer is showing buyers are taking initiative. Then when they build that offer big right behind it, is showing that they might have more to do. In the video examples we're going over, it's a big seller coming in, hitting the bid, and offering a lot behind it, giving you, or should give you, the thought and anticipation like, wow, this is the tipping point. That's the domino that's going to knock the rest down. This instant that I just left up in here, what just happened in here, 73 evens were bid, they go offer, and they go offer with 650. The next few ticks are easy, and they hit it right down. Let me play it, watch. They quickly hit the 72 75s. They quickly hit the 72 halves. They quickly hit the 72 quarters. They quickly hit the 72 evens, and down they go. Now, it's not always going to go down 100 points, but to anticipate the next point is always your job. You got to get it to go a point before it goes 10 points. Quoting is going to help you understand this, because when you quote, the faster the market moves, the louder you should get. When you see this, when you quote and you work on it, you should say, all right, let me quote it. I don't want to quote it because there's a delay between what you guys see. Like right there, no, it wasn't there. Right now, the 73 quarters go bid for 500. All right, I'm not going to quote it till it comes down here a little bit. There's a little delay of what you guys see to what I see. So if I'm quoting the market, I'm saying 3 even 3/4, 3 even 3/4. They just took out. Oh, right now, when that happens, I'm saying 73 even bid. 73 evens offered 600 times. So I'm going 73 even bid, 73 even bid, and all of a sudden this happens. And I go at 73 even, 600 at 73 even. 2 3/4 trade, 2 3/4 offer, 2 even offer, and so on. But my voice would go up just like a pit would to be able to see that someone is selling and has more behind it. Yes, Brad. So in this situation, momentum should push us to at least 72. Yes. But Tom, your questions are great, and I think they're also being asked on behalf of a lot of people. Don't feel, Tom's a pretty secure guy. He teaches people how to shoot guns, so I know he's pretty secure in his manhood. And he's not afraid to ask any kind of question. Don't be afraid to ask questions, and don't feel like you don't know enough if you don't know these things. You have to know these things. And they're very elementary, but not for most traders. They're not. If you don't know these things, you're in the majority of most other traders, not the minority. So feel okay about it, because these things are going to help clean up. You're going to go from a weakness to a strength because you know what to know. You know what's important. Now you're able to see it, to reinforce it, practice it. That's why there's no better place than this program. This isn't a course, it's a program to sharpen your skills, to get them and to sharpen them. So Lee says there's no way you can understand this without being able to quote. I agree with you, Lee. Tom says, why you added to should move? No. Well, because when I say we should go down is because doesn't mean we're going to go down. It's a probability thing, right? So when a big order hits a bid and sells a lot behind it, it should keep going down. If it doesn't, that's also a clue. Just like in this video, the 73 quarters, I got to replay it because this is good. The 73 quarters, I want to see exactly where they come bid though. It's just playing around right now. This market's moving back and forth. And then right here, bam, the 73 quarters go bid for like 400 or 500. And I know it's blurry, but they go bid for a lot. And then there's not a lot on the offer. So what should happen is it should go up another tick, and it does. But I'm looking at this because I'm bearish, and I'm like, if they take that guy out, I want to get short. Because that's the guy coming to the fight with a knife. And while a knife scares people sometimes, not if he gets his head blown off because he brought a knife to a gunfight. So it should go up, and it does a tick or two, but when it gets back through it, the downside was the right side. That's the qualification. That's the moment of qualification to get short your bearish bias, to execute your bias now. And as Bob puts it, either way you got information. And Chris puts it great. What was a bunch of random numbers are now making sense. Fantastic. And fantastic, what I do know about you English guys is, and people in Great Britain, is that fantastic is one of the biggest words from a compliment standpoint you guys give, correct? We don't use fantastic that much, or in the same context as you guys do. That's what the word is, though, randomness. When you could strip randomness out is when what? You start understanding stuff. Algebra is random until you start understanding it. The analogy I use, though, is you can't understand algebra if you don't know why 2 plus 2 or add 2 plus 2 equals 4. How are you going to get to, So quoting is 2 plus 2, and the algebra making sense is getting into this stuff. That's why I didn't want to lay out all the instances in one meeting because it's too much. Just get good at this. This is actually the toughest one to be able, so it'll make the other ones easy. I purposely wanted to do what's tough first. So if you can get used to reading this, recognizing resting bids and offers are easy. We'll watch market action, how it goes through it, how it holds, when it refreshes. That stuff is a little easier than this. We started with the harder instance, in my opinion, first, and then we'll go from there. Bob, go ahead if you had another question. I won't charge you for that one. All right, let me do this, though. Let me get rid of that. And then pull. Bob didn't have a question. He just keeps agreeing with everything I'm saying. I should have married you then. All right, here's one more. Whoa, look at this. High def is working. All right. The fourth and final one. Oh, almost paused the wrong one. It seems like in this market it's a little slower and the size is a little thicker. There's like 400 on the best bid and offer. So right now what I'm looking at, and I think this is the instance, see there's 900 here on the 12 even bid for 950 right here. I believe they take it out and go off for pretty big size. You see that? They hit it and went off for pretty big size. So they should drop a few more ticks. Took out the 12 evens and then offered behind it. So that your predictability goes up, or your ability to make the next few tick prediction goes up. And then if you quote, hold on, let's go back and show this. All right, watch this. Or watch this 12 even for 900, right? Watch what happens. Keep watching. Keep watching. Keep watching. 12 half bid. Tom, this is really going to be the home run with the bases loaded moment for you, because I'm going to show you guys two things. Watch this. All right. I paused it. Do you see this right here? This is the footprint, right? There's only like 9 traded on what? 12 even. 12 even is the bid, right? There's 937 there, right? So once this trades out, there'll probably be just around 1,000 trading there. Now watch it. See this number right here my cursor is? Watch it. A total of around, I think, 936. They took out the whole order at 12 even. That's what traded on 12 even. Now the 12 evens we know from the dome went offered, right? And follow my cursor over. What'd they go offer with? Pretty big size, 500, right? Come back over here, follow my cursor. It only came back to trade 18 of them at 12 even when it was offered. So nobody really got filled. They hit them and offered them. So they should hit the 1175s quick, and they did. They sold 280, but it still bid. It went offer bid. That's why 160 came back and traded on the 1175. Let's play it. And you can see the downside ends up being the right side on this. Let me fast forward it and see where it ends up. Ends up just leaking lower and lower and lower. Now, if you understand that relationship, everything else could and should be cleaner for you. What trades based on what wants to trade. And you'll be, yeah. So Tom is excited. I think this maybe upticks. The heck is this? I was thinking of getting a one of these electric desks. All right, let me change the screen around here. Couple more questions. Bob says, watching the size or quoting the size, and then you get the feel for what is happening. All right, I thought that was a question. There's another question from Brad, and he says, hold on, let's get that guy off of there. Okay. I was watching some YouTube videos of the desks. It's an investment that no other guys have made and other guys haven't, and I think it's maybe worth it. Not the treadmill, but if you're in front of your desks a lot, and I'm not always in front too much, your workstation, something to end up maybe thinking of doing. Brad, if big size hits the bid and the bid goes offer and has more size behind it, then if you want a short, should you hit the bid? You should hit the existing best bid. Yes. So his question is this. If big size hits the bid and the bid goes offer with a lot of size, like many of the recordings we're showing, and you wanted to get short, you should hit what currently is the best bid. You shouldn't wait and join what is now the large offer. The best bid is what you should hit, which would be the next one down. That's going to assure you of getting in the trade and not missing it. The guys who are going to miss it are the guys joining the offer and probably trying to get out of a long. And now, if I was long, I'm definitely hitting the bid, which is a market order. We're going to have in one of the meetings, I mean, there's a lot of stuff that we're meeting once a week, so there's a lot of meetings we're having, but there's a lot of stuff to go over. One of them is order types, and we'll pull up a dome and we'll just click around and show bids and hitting bids and offers and how to use market orders. There's an exercise I'm going to have you guys do before that, which is mastering your dome. And then we'll actually see if anyone wants to get tested, and I'll fire orders at them. That'll be the first time. If someone voluntarily wants to get tested, if you worked for me, I would make people get tested and quiz them and see if they were ready to really start trading. That's the best way you could emulate emotion. Isn't by kind of judging and pulling statistics from your trading strategy, and most people use sim that way. Is the best way to simulate or emulate kind of emotion on a sim is have someone yell at you while you're putting in orders. Believe it or not. That's it. Next week we might have a guy do a trader spotlight interview. You guys will have these recordings and these links. I'm not going to give all the ones I've clipped, but I want to give these four for you guys to go over. Give me a day to put those up along with the rebroadcast of this. But next session, we're going to have possibly a trader. I got to talk with him, but Progress is someone who's an Edge member, a little bit of their background. He's got a good and interesting background, and it'll be helpful for everyone. That's how we pretty much did the Edge meetings last year, and now we've added so much more, but we don't want to get away from those because you got to know how other guys are doing, both the good, the bad, and the ugly, to clean up weaknesses and see how others turn the corner or are turning the corner. You just don't want to listen to me. That's why Woj is here, and that's why these trader spotlight interviews are important. I'm going to stop the recording for now. That'll be at the end of